Hello everyone. In this presentation we're going to take a look at our homework from Chapter 15. In Chapter 15 we actually learned all about different financial statement analyses. And there are various analyses and ratios. Another thing we're going to see in this chapter are different ratios that accountants like to use when they're analyzing the results of their operations. Okay, so what we have here is a comparative income statement. So we have the income statement for the end of this year versus the income statement for the end of last year. We can see sales are greater this year, gross margins greater this year, expenses are also greater this year, and at the end of the day, net income is greater this year. So you might say to yourself, okay, this year was better. So members of the company's board, they're happy that this year is better, but they're surprised. Why are they surprised? Net income only increased by $38,000 when sales increased by $2 million. So they're thinking, why? I mean, if sales increased by $2 million, you would expect net income to increase by a lot more than just $38,000. Effectively, it's almost the same. So although they are happy that net income is growing, it's not growing at the pace that they would expect it. And so what companies tend to do is they prepare what's known as common size income statements. And basically what a common size income statement is you make sales, the top line of your income statement, you show it in percentage terms. So the top line sales is 100%. And then everything else on the income statement is going to be a percentage of sales. So as an example, cost of goods sold is 62% of the sales. Last year, 58%. Is this negative trend or positive? This is negative. The cost of goods sold is getting higher. Our costs are getting higher as a percentage of sales this year. That now we're starting to explain why net income didn't go up as much as anticipated. And our gross margin, it went down. This is negative trend. Selling expenses as a percentage of sales, it increased. That's a negative trend. Admin expenses actually went down as a percentage of sales. That's a positive trend. Net income is a huge, right? 12.9 to 10.3. That's all because pretty much the cost of goods sold. All right, so you can see this is how we can better analyze as a percentage of sales. They're called common size statements. Next, we have comparative financial statements, and you're going to see we have both a comparative balance sheet as well as a comparative income statement. We have last year versus this year. All right, the company did not issue any new common stock during the year. They have a total of 800,000 shares of common stock outstanding. So hopefully these are terms and statements that you remember from your financial accounting class. The interest rate on the bonds are 12%. The income tax rate is 40%. Dividends per share is 75 cents last year, 40 cents per share this year. The market value of the stock is $18. And so that's some additional information in addition to the balance sheet and the income statement. We need to figure out some following ratios. First, working capital. Working capital is a quick calculation that simply takes our current assets and subtract out our current liabilities. Basically, what the working capital does is it tells us how much cash that we have available after we pay off our current liabilities. All right, so that is something that we want to see as positive as possible at all times. The next item is called the current ratio. The current ratio is not current assets minus current liabilities, but the current ratio is current assets divided by current liabilities. And once again, obviously you would like to see your numerator higher than your denominator here. So the higher this is, the better. This is stated in terms of not a dollar amount, but a simple number. And then we have something called the acid test ratio. The acid test ratio is very similar to the current ratio. The only difference is in the numerator, instead of taking all of the current assets, we're simply going to take the cash plus the receivables plus any marketable securities we can liquidate as quickly as possible. It ignores other current assets like inventory, like prepaid expenses, and the like. Even though they're current assets, they're not easily, or I should say quickly liquidatable. So we use these assets here as the quick assets, acid test ratio. And you can see with the acid test ratio, a little bit lower than the current ratio. The good thing though is it's still positive. All right, it's still above 1.0, and that's what we want to see. That means we are really testing to see if we can pay off and afford all of these current liabilities. All right, so these are various ratios, and more of the same in the next homework problems. These are all the ratios that companies tend to do. Comparative financial statements again. This is the exact same setup as the homework problem we just went through, but we're going to take a look at some additional calculations. The first is called the accounts receivable turnover. The accounts receivable turnover basically tells us how many times that we have in sales that we are going to have outstanding in receivables. As an example, your numerator is your sales on account. So you go to the income statement, you'll find that $79,000. Your denominator is going to be the average accounts receivable balance. Simply put, last year's receivable plus this year's receivable divided by 2, that works out to 7.38 times. That means when we sold 7.38 times our average receivable. And we're going to take that one step further and calculate the average collection period. Your numerator is going to be 365 because that is the number of days in the year. Your denominator is going to be the receivable turnover that we just calculated in the first calculation, 7.38. That works out to 49.46 days. Typically what this means is it takes us from when our customer enters into the receivable to when they pay, it takes an average of 49 days for that whole process, from entering into the receivable all the way to collecting it. Okay? Inventory turnover, very similar to accounts receivable turnover. Your numerator is going to be your cost of goods sold, which we're going to grab directly from the income statement, and your average inventory balance. Once again, the balance sheet, your ending inventory from last year plus this year divided by 2, 5.81. That's how many normal amount of inventories on the shelf that we've sold. We've sold out our inventory 5.81 times throughout the year. The average sale period, very similar to the average collection period. The numerator is the same, 365 days, the number of days in the year. But your denominator is going to be the inventory turnover, which we just calculated at 5.81. That works out to 62.82 days. What this tells you is basically from the time of the inventory of purchase all the way through to selling it and getting it off the shelves, it takes an average of 62 days. Okay, almost 2 months, just about 2 months. All right, that's why the inventory turnover is almost 6. We sell out our average inventory about 6 times, about every 2 months. What that means is, another way to put it, if we don't buy any more inventory in about 2 months, we'll have empty shelves, if you want to put it that way. Okay, the operating cycle is going to be the sum of the average sale period plus average collection period. And you add the two, 49 plus 62, 112.28 days. That is from the initial purchase of the inventory through selling it to your customer through finally collecting from your customer. That whole time period is called the operating cycle. And last but not least, something called the asset turnover. And the numerator would be sales, but and which you get from the income statement, but your denominator is average total assets. So you take total assets from year 1 plus year 2 and divide by 2. Simple average, 1.64. Clearly, we want to see this turnover over 1.0. This basically tells you how well you are utilizing your assets as we are, using them in the sales process. All right. Clearly, we want more sales than we want average total assets. If we have too much assets that are not really generating sales, this asset turnover will be less than 1.0. That is not ideal. Same company, same financial statements, more ratios. What we're going to do now is we're going to take a look at a few more. Times interest earned ratio. This is a ratio that is actually looked at by the banks that lend companies money. They want to make sure that this times interest earned ratio is high enough where they're comfortable that this company has the ability to pay back their interest on their loan. The numerator is, you're going to get it right from the income statement. It's going to be a subtotal called earnings before interest and taxes. EBIT. EBIT is what it's called. And EBIT is a subtotal that you're going to see on the income statement. I will show it to you here. Where is it? Income before, here it is, $6,500, $7,000 last year. All right, so we come down here. All right, you can see $6,500. That is basically your net operating income. And your denominator is going to be interest expense. You can see that the earnings is 10.8 times higher than the interest expense. This is healthy. This tells the bank that this company can afford to keep paying the interest on the loan. If this times interest earned ratio gets a little bit smaller, we're actually going to start, if we're the bank, we're going to start to worry that this company cannot pay their interest in a timely manner, and that's not a good thing. Okay, another ratio called debt to equity ratio. As it states, debt to equity, total liabilities divided by total equity. All right, and in here we can see that the liabilities are 44% of equity. We want this ratio to be less than 1. What this tells us is, right, the liabilities are in check. We've got healthy equity, a lot higher than the liabilities, and this is something that would need to be analyzed on a year-by-year method. And then something called the equity multiplier. Your numerator is your average total assets. Once again, this year plus last year divided by 2. Your denominator is average total equity. This year plus last year divided by 2. And we would like to see this healthy over 1.0, which basically means our assets are high enough. If we see our assets are lower than equity, what does that mean? That means a lot of liabilities when you really think of the accounting equation. Not good. Not good. So equity multiplier is something that we want above 1.0 as well. Same company. We're continuing with the same company. The reason I wanted to do that is for obviously consistency purposes, but I also wanted you to kind of get comfortable with these numbers. Okay, now we're going to concentrate a little bit more on some income statement calculations, as well as some other going back to the balance sheet. So gross margin percentage, the gross margin, which you know is a subtotal on the income statement. It's the sales less the cost of goods sold and divided by your sales. We want our gross margin, or some accountants call this the gross profit. We want it to be as high as possible. In this case, 34%. Net profit margin is really the bottom line on the income statement, which is your net income, divided by the top line on your income statement, the sales. We want this number to be as high as possible as well. All right, this tells us what net income is, including not only the cost of goods sold, but all of the expenses is factored into this net income number. Return on assets. What we're going to do, this is a little bit more confusing, but follow the formula. Our numerator, we're going to take our net income, you grab that from the income statement, plus the interest expense times 1 minus the interest rate. So the interest rate, tax rate. The tax rate here is 40%. So that would be the interest times the 60% in this case, which is really 100% less the 40% tax rate. All right, that's how much the interest is saving you. That's what that is doing. It is telling you, okay, my $600 in interest expense, I'm actually saving 60%. All right. Okay. Your denominator is your average total assets. We get a percentage. The return on assets. We want this number to be as high as possible. And last but not least, your return on equity. Your numerator is going to be the net income, and your denominator is going to be your average equity. The equity at the end of this year plus last year divided by 2. So all of these ratios, what can you do with these ratios? You know, it's one thing just to do the math, but it's another thing, what do you do with them? Well, basically, you compare them to yourself from the prior year, from the prior quarters. You compare these analyses to what was expected, meaning your budget. You can have a budget, an expectation for gross profit or gross margin. All right, the expectation before the year started, and see where you actually wound up. And so you can also, if you are a publicly traded company, and I've said this in class before, you can compare yourself to your competitors, and that would be a good thing as well. Okay, same company, just some more ratios. All right, earnings per share. This is also known as EPS. This is pretty common for those of you that follow any business financial news. I'm sure you've heard of this earnings per share before, and this is something that Wall Street analysts zone in on all the time. Your numerator is going to be your net income, and your denominator is going to be the average number of common shares outstanding. And we said earlier that was 800,000 shares. Because we're dealing with these numbers are in thousands anyway, we'll drop off the last 3 zeros on you see it says dollars and thousands. So we're going to drop off the last 3 zeros on our common shares outstanding, just like we dropped the last 3 zeros on these dollar amounts. $4.43 per share. Price earnings ratio, also known as the PE ratio. The numerator is going to be the market price per share, which in this case is 18. We were told that, not in the financial statements, but in the information given to us in addition to the financial statements. Your denominator, what we just figured out, the earnings per share. All right, so the PE ratio is 4.06. Now, if you are an investor and you're thinking of buying this stock, we want to see a PE ratio that's lower. All right, and as you hold the stock, you want to see your PE ratio start to inch up a little bit, but if it goes up a little too much, then the stock may be ready to be sold because it's a little bit too expensive. All right, so this is something, once again, that Wall Street analysts utilize all the time. Dividend payout ratio. the dividends per share, which the author gave us. That's not something you would find in the financial statement. You would need to know what that is. Divided by the earnings per share, which we just calculated, it's 9.03%. If you are an investor and you are in the stock to receive the dividend, you want to see this dividend payout ratio be as high as possible. All right, versus the dividend yield, the difference between the dividend payout and the dividend yields is in the denominator. The denominator of the dividend yields is the market price per share. So we can see it's 2.22%. Once again, just like the dividend payout ratio, we want to see the dividend yield ratio to be high. And then last but not least, the book value per share. Your numerator is the total equity divided by the number of shares outstanding. All right, for stockholders, we would like to see the book value per share keep growing. This tells us that our equity section is growing and growing and growing. That is good over the long term. All right, that means the company is profitable consistently year in and year out. And last but certainly not least, let me take a look at this last example. And here what we're going to do is we're going to do trend analysis. We're going to look at different years into the future or past years more in a row, 5 or 10 or 15 years in a row. And basically what we do is we are going to do something very similar that we did previously. Is we're going to take our sales, all right, and all of our other items, cash, receivables, inventory, liabilities, whatever we want to analyze. Year one, everything is going to be 100%. That is the base year. And all of the future years is going to be a percentage. All right? A percentage of year one. So as an example, sales, $1.8 million. That's 100%. In year two, it was $1,980,000. That is 110%. That is $180,000 more, or 10% more than year one. You want to see, at least for sales, you want to see your percentages grow, right? That's a good thing. Every year your sales are going up. Cash, it's bouncing around 100, 130%, 96, 80, 60. Our cash balances are actually going down significantly. And by the time we get to year three, you can see it's only 60% of year one. Now, that could just be a timing difference, or that could be a negative trend. We would need to analyze that. Accounts receivable is growing. Now, because sales are growing, we would expect accounts receivable to grow as well. But the receivables are growing way faster than the sales are. This is not good. This means we're making sales, but we're not collecting in a timely manner. This could eventually relate into higher bad debts. We don't want that to happen. Inventory is growing, which makes sense because sales are growing. And then our current liabilities are growing. They are growing, and it seems like they're growing more aggressively than sales. So that's something we might want to look into as well. So once again, trend data, trend percentages. Basically what you do is year one is the base year, and everything is going to be based off of that. And we can analyze it that way.